Once maturity is understood, companies move to step 3, defining materiality. Materiality is the process of identifying which sustainability topics truly matter. Not all sustainability issues are equally relevant to every company. A manufacturing company will face very different sustainability risks compared to a digital services firm. Water scarcity may be critical for agriculture, but less relevant for software. Biodiversity may be material for mining, but minimal for consulting. Trying to tackle every topic with the same level of depth is neither realistic nor effective. This is why sustainability requires prioritization. Prioritization allows companies to focus time, resources, and attention on the issues that carry the highest relevance for their business model. Materiality helps separate what is useful to know from what is critical to act on. Materiality is not about ignoring issues. It is about recognizing that not all issues carry the same weight. As you start working with sustainability data, reports, or assessments, you may notice something that feels confusing at first. The same sustainability issue appears under different names, different categories, or even different sections depending on the framework being used. What changes is how frameworks name and organize them. Frameworks, as the ones mentioned in the 4th lesson of Module 4, are not neutral lists. Each one is built with a specific purpose in mind. Some are designed for regulatory reporting, others for investor decision-making, and others for sector-specific risk management. Because of this, frameworks structure sustainability topics in different ways. For example, some frameworks organize topics strictly under environmental, social, and governance categories. In this structure, climate change sits under environmental, workforce issues sit under social, and ethics and business conduct sit under governance. Other frameworks use different logic. Some group topics based on how financially material they are for a specific sector. In this case, the same issue, such as biodiversity, may appear under different headings depending on the industry. In agriculture, it may be framed around ecosystem services. In mining, it may appear under waste, tailings, or land use. You may also see naming differences. What one framework calls water and marine resources, another may simply call water and effluents. What one framework labels as consumers and end users, another may describe as product responsibility or customer well-being. Despite these differences, the underlying issues remain the same. Human rights, product safety, and ethical conduct do not change in substance. Only the structure, terminology, and emphasis change. This is why, when doing materiality analysis or sustainability reporting, clarity is essential. A company must be clear about which framework it is aligning with, because that choice determines how topics are grouped, what language is used, and what is expected in terms of disclosure and performance. Understanding framework variation allows you to focus on what really matters. Instead of getting stuck on labels, you learn to recognize the core sustainability issue beneath the terminology. That skill is essential for working confidently across different sustainability frameworks and contexts. To make this more concrete, let's look at an example using the CSRD context. Under CSRD, sustainability topics are organized using a clear environmental, social, and governance structure. However, the way topics are named and grouped is still a matter of categorization, not substance. For example, climate-related action fields are often grouped under climate change and energy management. Within this action field, you will still find familiar issues such as greenhouse gas emissions, energy use, transition planning, and adaptation. The difference is that CSRD brings these elements together under a single, coherent theme to support consistency and comparability. Biodiversity provides another example. Under CSRD, biodiversity-related topics may be grouped under biodiversity impacts covering land use, ecosystem services, species risk, and ecosystem degradation. In other frameworks, these same issues may appear under natural capital or ecosystem services. The underlying concern does not change, only the framing does. On the social side, topics such as labor rights are often grouped under working conditions and labor rights. This action field captures issues related to fair treatment, working hours, health and safety, and respect for worker rights, whether within a company's own workforce or across its value chain. Community-related impacts are often framed under community relations. This grouping brings together topics such as access to housing, land impacts, human rights concerns, and engagement with affected communities rather than splitting them. Some topics appear across more than one pillar. Cybersecurity, for example, may be positioned under governance because it relates to controls and risk management, but it also has clear social implications through data protection and privacy. Similarly, product quality and safety is often treated as a social issue because it focuses on protecting consumers, even though it relies heavily on governance systems. The key takeaway is this: CSRD changes how sustainability topics are organized, not what they are. The same core issues, such as climate, biodiversity, human rights, product safety, ethics, remain. CSRD simply provides a structured language and action field logic to make these issues easier to prioritize, manage, and report consistently. Understanding this helps you focus on substance rather than labels, which is essential when working across sustainability frameworks. By now, it should be clear that sustainability covers a very wide range of topics: climate change, biodiversity, water, pollution, human rights, supply chains, governance, diversity, and many more all fall under the sustainability umbrella. In this program, we've intentionally explored each of these topics to show how broad the sustainability agenda really is. But we also stated that not all sustainability issues are equally relevant to every company. No organization has the capacity, resources, or influence to address every sustainability topic with the same level of depth and urgency. Some issues may not apply at all, depending on the company's sector, size, geographic footprint, and business model. There are simply too many topics to tackle at once. For example, water scarcity may be a critical risk for agriculture, manufacturing, or energy companies, where water availability directly affects operations. For a digital services company, water may still matter, but it is unlikely to be a top strategic concern. And the same logic applies to biodiversity. Biodiversity impacts are highly material for sectors such as mining, infrastructure, and energy, where land use and ecosystem disturbance are significant. For a consulting firm, biodiversity may exist more as an indirect or reputational issue. This is why sustainability requires sector and business relevance. This leads to the need for strategic focus. Sustainability becomes effective when companies identify and prioritize the topics that are most relevant to their business model and stakeholders. This allows them to allocate resources where they can have the greatest impact and where risks are most significant. The process that enables this focus is called materiality. Materiality is how companies narrow down the long list of sustainability topics into the ones that are most relevant for decision-making, strategy, and reporting. It provides structure and clarity in a space that would otherwise feel overwhelming. In the next section, we will look more closely at how materiality works and how it helps translate sustainability from a broad concept into a focused and actionable strategy. Before we move into double materiality, there's one fundamental principle we need to clarify. Materiality is sector-specific. Not all sustainability issues carry the same weight for every industry. What is material for one sector may be far less relevant for another. That's why materiality is typically defined first at the sector level, and only then refined at the company level. Let's look at a few examples. In hardware and electronics manufacturing, the physical nature of the products, the complexity of global supply chains, and the end-of-life impact all shape what becomes material. Now compare that to software or SaaS companies. Their material risks shift significantly. Here, data privacy and cybersecurity become critical. AI ethics and responsible technology use rise to the forefront. Energy use is less about factories and more about data centers. In apparel and clothing, supply chain transparency, labor conditions, water usage, and environmental impact dominate. The industry's reliance on global sourcing creates a different material profile. And in pharmaceuticals, patient safety, product access, ethical marketing, and regulatory compliance are key, alongside data governance and R&D ethics. The point is this: materiality is not universal. It is shaped by business models, value chains, stakeholder expectations, and systemic risks specific to each industry. That's why frameworks like the SASB materiality map define material topics at the sector level first. Companies then refine those topics based on their specific strategy, geography, and stakeholder landscape. Understanding this sector lens is essential because when we move into double materiality, we'll see that we're not only evaluating what affects the company, but also how the company affects society and the environment. And that's where the complexity deepens. Now that we understand why prioritization is necessary, let's look at how materiality is actually done in practice. Materiality is not a subjective exercise, it is an evidence-driven and participatory process. Its purpose is to identify and prioritize the sustainability topics that are most relevant for decision-making, strategy, and long-term performance. The materiality process typically unfolds across 4 key phases. The first phase is documentary review. This is where the company analyses what already exists. This includes sustainability reports, internal policies, risk registers, industry benchmarks, and applicable regulations. The goal is to build a baseline understanding of current commitments, known risks, and external expectations. The second phase is internal engagement. Here, companies engage with employees and management through workshops, interviews, or surveys. This step helps reveal how sustainability is actually embedded in operations, decision-making, and strategy. It also surfaces internal priorities, challenges, and blind spots. The third phase is external engagement. This involves dialogue with key stakeholders such as customers, investors, suppliers, regulators, and communities. External engagement helps capture perspectives that the company may not see internally, including reputational risks, legal exposure, and emerging market expectations. The fourth phase is prioritization and validation. In this phase, sustainability topics are assessed based on their scale, scope, and likelihood of impact. The results are then reviewed and validated with leadership to ensure alignment with the company's strategic direction and risk appetite. Together, these phases form a continuous loop rather than a one-off exercise. Materiality evolves as the business, its context, and stakeholder expectations change. At the heart of this process is the understanding that different perspectives must be considered. Internal insight alone is not enough. External expectations alone are not enough. Materiality emerges from combining both. This is why the materiality process strengthens decision-making. It helps companies focus resources where risks are highest and where positive impact can be maximized. So far, we've talked about materiality as a way to focus on what matters most. Double materiality builds on this idea by adding 2 complementary perspectives. Instead of asking a single question, double materiality asks 2 questions at the same time. The first question is about the business. The second question is about the world. The first lens is financial materiality. Financial materiality looks at how sustainability issues affect the company itself. It focuses on enterprise value, growth, competitiveness, and long-term resilience. For example, rising carbon prices can increase operating costs, water scarcity can disrupt production, supply chain disruptions can affect delivery, revenue, and reputation. From this lens, sustainability issues matter because they influence financial performance and business continuity. The second lens is impact materiality. Impact materiality looks at how the company affects people and the environment through its activities and value chain. This includes impacts such as biodiversity loss, human rights conditions and supply chains, community displacement, or product safety risks. Here, the question is not whether the issue affects profits, but whether the company creates positive or negative effects in the world. These 2 lenses are distinct, but they are not separate. They are deeply interconnected. When companies ignore their impacts on people and the environment, those impacts eventually become business risks. Environmental degradation leads to resource scarcity. Poor labor practices lead to reputational damage and legal exposure. Unsafe products lead to loss of trust and financial consequences. And this is why we talk about double accountability. Companies are accountable not only for how sustainability issues affect their financial performance, but also for how their actions affect society and the planet. Double materiality encourages companies to look outwards and inwards at the same time. Outwards to understand their impacts on the world. inwards to understand how those impacts return as risks or opportunities. Together, these two perspectives provide a more complete and realistic view of sustainability. They help ensure that materiality is not just about protecting the business, but also about acting responsibly within the broader system the business depends on. Now that we understand double materiality, the next step is to understand how it is actually used to make decisions. This slide shows the logic companies use to determine which sustainability topics are considered material and what needs to be disclosed. The starting point is always a broad list of potentially relevant sustainability topics. This list typically comes from industry benchmarks, known risks, or stakeholder input, earlier analysis of due diligence or risk assessments, if available, and the long list of topics in whatever framework used in the end reporting process. Example, the CSRD or GRI. At this stage, nothing is excluded yet. The goal is to make sure that all potentially relevant topics are on the table. Each topic is then evaluated through two lenses of double materiality. The lens asks the question, are there material impacts arising from this topic? This refers to impact materiality. It looks at whether the company's activities create significant positive or negative effects on people or the environment. If there are no material impacts, then from an impact perspective, there may be nothing to disclose. The second question asks, are there material risks or opportunities arising from this topic that are not directly linked to impacts? This, on the other hand, refers to financial materiality. It looks at whether the topic affects enterprise value, costs, revenues, competitiveness, or resilience, even if the company's direct impact is limited. If neither material impacts nor material financial risks or opportunities are identified, the topic is considered not material and disclosure is not required. However, if either lens is triggered, the conclusion is clear, and the matter is material. Once a topic is deemed material, understanding what to disclose becomes the next step. If the topic is material due to impacts, the company must disclose. A single topic can generate impacts on people or the environment and at the same time create financial risks or opportunities for the business. This is why materiality does not lead to a single type of disclosure. It leads to different disclosure pathways depending on how and why the topic is material. The key takeaway is this: materiality is not about producing a list for reporting purposes. It is a decision framework that links impacts, risks, opportunities, and disclosure in a structured and defensible way. This logic is what allows sustainability reporting to move beyond generic statements and focus on what truly matters for both the business and the world around it. Now that we've seen how topics are assessed through the lens of impact materiality, the next question is how impacts are actually evaluated. Impact materiality is not about whether an issue is uncomfortable or reputational. It is about how serious an impact is on people or the environment, and how likely it is to occur. To do this consistently, companies assess impacts using two main dimensions: the severity of the impact and, where relevant, the likelihood of the impact. Let's start with severity. Severity measures how serious an impact would be if it occurs. It is not a single factor, but a combination of three elements. The first element is scale. Scale looks at how grave the consequence is. For example, loss of biodiversity, serious injury, or violations of human rights are considered high-scale impacts because the harm is significant. The second element is scope. Scope looks at how widespread the impact is. This could mean the number of people affected, the size of an ecosystem impacted, or the geographic spread of the harm. The third element is irremediability. Irremediability asks how difficult it is to reverse or compensate for the damage. Some impacts can be corrected over time. Others, such as species extinction or permanent health damage, cannot be undone. Together, scale, scope, and irremediability determine how severe an impact is. Now let's look at likelihood, which applies mainly to potential impacts. Likelihood assesses how probable it is that an impact will occur. One aspect of likelihood is frequency. This looks at how often similar events have occurred in the past, either within the company or across the industry. Another aspect is probability, which may be informed by expert judgment, risk modeling, or scenario analysis. Some impacts may be extremely severe but unlikely. Others may be less severe but highly probable. Both need to be considered. The outcome of this assessment is typically a composite impact materiality score. This score combines severity and likelihood, either through multiplication or weighted judgment. The purpose is not mathematical precision, but consistent prioritization. Impact materiality metrics help companies answer a critical question: which impacts require urgent attention because of their seriousness, regardless of financial implications? This is what ensures that sustainability decisions are grounded in responsibility toward people and the environment, not only in business risk. Once the context is clear and the materiality logic is understood, the next step is to move from theory to practice. This is where companies begin by building a long list of sustainability topics and identifying their impacts, risks, and opportunities, often referred to as IROs. At this stage, the goal is not prioritization, the goal is completeness. Companies need to map out all the actual and potential impacts that may arise from their activities and value chains. These impacts can be positive or negative, and they may occur in the short term or the long term. Some impacts are intentional. For example, reducing emissions or improving worker safety may be direct outcomes of company strategy. Other impacts are unintended side effects, and these can emerge through supply chains, operational decisions, or interactions with communities and ecosystems. It is also important to distinguish between impacts that are reversible and those that are irreversible. Some impacts can be mitigated or corrected over time. Others, such as ecosystem degradation or loss of life, may have lasting or permanent consequences. This same logic applies to risks and opportunities. Risks refer to situations where sustainability issues could negatively affect the company's operations, finances, or reputation. Opportunities refer to areas where sustainability can create value, innovation, or competitive advantage. Importantly, impacts, risks, and opportunities are not identified from a single source. They are informed by internal data, such as operational performance and incident records, and by external inputs, including stakeholder feedback, expert assessments, regulatory insights, and industry analysis. This step ensures that materiality decisions are grounded in real evidence rather than assumptions. By building a comprehensive long list and clearly identifying IROs, companies create a solid foundation for the next step, which is evaluating significance and determining materiality. Once impacts, risks, and opportunities have been identified, the next question becomes clear. Not all impacts carry the same weight. Some impacts are minor and limited, others are severe, widespread, or irreversible. This is why companies need a structured way to determine which impacts are most significant and therefore require priority attention. To do this, companies assess impacts using two key dimensions: severity and likelihood. Let's start with severity. Severity measures how serious an impact would be if it occurs. It is assessed using three components. The first is scale. Scale looks at how grave the consequence is. For example, minor inconvenience is very different from serious injury, loss of livelihood. The second is scope. Scope examines how widespread the impact is. This could mean how many people are affected, how large an area is impacted, or how much of the value chain is involved. The third is irremediability. Irremediability looks at whether the impact can be reversed or compensated. Some impacts can be corrected through remediation. Others, such as permanent environmental damage or loss of life, cannot be undone. Together, scale, scope, and irremediability define how severe an impact is, regardless of how often it occurs. Now let's look at likelihood. Likelihood estimates how probable it is that a potential impact will occur. This can be assessed based on past incidents, industry patterns, expert judgment, or modeling. Likelihood considers both probability, meaning the chance of occurrence, and frequency, meaning how often similar events have happened or may happen over time. An impact may be highly severe, but unlikely, or less severe, but highly frequent. Both scenarios require careful consideration. The significance of an impact is determined by combining severity and likelihood. When these two dimensions are assessed together, they create a risk-based framework for prioritization. This allows companies to consistently compare different impacts across topics, locations, and value chains. Importantly, this assessment is not purely numerical. It combines quantitative data and qualitative judgment to ensure that critical impacts are not overlooked simply because they are difficult to measure. This step is what transforms a long list of impacts into a focused set of priorities. It ensures that sustainability efforts are directed toward the issues that matter most for people, the environment, and long-term resilience. Now that we've covered impact materiality, we turn to the second lens of double materiality, financial materiality. Financial materiality looks at sustainability issues through a business lens. The question here is not how the company affects the world, but how sustainability issues affect the company's financial performance, position, and long-term resilience. To assess this consistently, companies evaluate financial materiality using several key dimensions. The first dimension is financial exposure or magnitude. This looks at the potential financial consequence if a sustainability issue materializes. Examples include revenue loss, increased operating costs, asset impairment, liability risk, or additional capital expenditures. This step helps estimate the size of the potential financial effect. The second dimension is time horizon. Not all sustainability-related financial impacts occur at the same time. Some risks are immediate, while others emerge gradually. Companies typically classify impacts as short-term, meaning within the next 1 to 3 years, medium-term, meaning 3 to 10 years, long-term, meaning 10 years or more. This distinction matters because near-term risks may require urgent action, while long-term risks may shape strategy, investment decisions, and business model transformation. The third dimension is business dependency and sensitivity. This assesses how dependent the business model is on the issue in question. For example, a company with water-intensive production is highly sensitive to water scarcity. A company reliant on fossil fuel-based supply chains is highly sensitive to energy transition risks. The higher the dependency, the greater the financial sensitivity to changes related to that issue. The fourth dimension is resilience and mitigation capacity. This looks at how prepared the organization is to manage or absorb the financial impact of a sustainability issue. This may include factors such as insurance coverage, diversification of suppliers or markets, strategic flexibility, or existing mitigation measures. If preparedness is low, financial materiality is higher. If resilience is strong, the financial risk may be reduced, even if the issue itself is significant. Together, these dimensions are combined to produce a financial materiality score. This score is often calculated using a weighted approach that reflects magnitude, timing, dependency, and resilience. Again, the goal is not perfect precision, but consistent and transparent prioritization. Financial materiality metrics help companies understand which sustainability issues could most significantly affect enterprise value, and therefore require integration into risk management strategy and financial planning. In the next step, we will look at how impact materiality and financial materiality are combined to define final priorities and guide sustainability strategy and target setting. Up to this point, we've looked at impact materiality and financial materiality as structured assessments. However, sustainability does not exist in a vacuum. The significance of a sustainability topic often depends heavily on context. This is where contextual factors and weighting variables come in. They help refine materiality assessments so that priorities reflect the company's real-world situation rather than a generic model. The first contextual factor is geographic exposure. Some sustainability issues are highly location-specific. For example, water scarcity may be a critical issue in arid regions, while being far less material in water-abundant countries. Geographic exposure asks how closely a sustainability topic is linked to the locations where a company operates or sources from. The more exposed the business is to a specific geographic risk, the higher the weight that topic may receive. The second factor is regulatory and market pressure. Sustainability topics attract different levels of scrutiny depending on regulation, investor expectations, and customer demand. Issues that are heavily regulated or closely monitored by markets tend to carry higher materiality, even if their current impact is moderate. This factor also captures emerging regulation, not just what is already in force. The third factor is stakeholder concern and perception. Materiality is not determined by data alone. Stakeholder expectations play a critical role. This factor reflects how important a topic is to key stakeholders such as employees, customers, investors, suppliers, and communities. A topic may have relatively low measurable impact, but still be highly material because stakeholders care deeply about it. Stakeholder concern is often captured through surveys, interviews, or focus groups and translated into weighted importance scores. The fourth factor is value chain relevance. Many sustainability impacts do not occur within a company's direct operations. They may arise upstream through suppliers or downstream through product use or disposal. Double materiality requires companies to assess sustainability issues across the entire value chain, not just within their own facilities. The more broadly an issue spans the value chain, the more weight it may carry in the assessment. Together, these contextual factors act as adjustment lenses. They do not replace impact and financial assessments, but they refine them. At this point in the process, all the core building blocks are in place. We've assessed impacts through the lens of severity and likelihood. We've evaluated financial exposure, timing, dependency, and resilience. And we've adjusted those assessments using contextual factors such as geography, regulation, stakeholder concern, and value chain relevance. This slide shows how all of these elements are integrated into a single materiality scoring framework. The first block is impact materiality. Impact materiality is measured through severity and likelihood using factors such as scale, scope, irremediability, and probability. The output of this block is an impact score, which reflects how serious a topic is for people and the environment. And the second block is financial materiality. Financial materiality is measured through magnitude, time horizon, sensitivity, and resilience. The output of this block is a financial score, which reflects how strongly a topic could affect enterprise value and financial performance. The third block is contextual weighting. Contextual weighting adjusts the impact and financial scores based on real-world conditions. This includes geographic exposure, regulatory pressure, and stakeholder expectations. Rather than changing the underlying assessment, contextual weighting refines it. The final block is classification. Here, topics are positioned within a matrix that compares impact scores against financial scores. This positioning allows companies to classify topics into materiality categories such as high, medium, or low priority. This step transforms complex data into clear decision signals. Instead of dozens of disconnected assessments, decision makers see a structured view of which sustainability topics require immediate action, strategic planning, or monitoring. The key takeaway is that materiality scoring is not about numbers for their own sake. It is about creating a transparent, repeatable, and defensible process for prioritizing sustainability issues. Now let's deep dive into an actionable step-by-step guide into the materiality process. Step 1 is set purpose and scope. Before any scoring, surveys, or analysis begins, the most important step is to define why you are doing the materiality assessment and what it will cover. Materiality is not a generic exercise. Its design depends entirely on its purpose. Some organizations conduct materiality to comply with regulation. Others use it to refine sustainability strategy, strengthen risk management, or inform long-term planning. At this stage, companies clarify both lenses of double materiality. This means confirming that the assessment will consider financial impacts on the company and impacts of the company on society and the environment. Next, the scope of the assessment is defined. This includes deciding whether the assessment covers the group level, subsidiaries, or joint ventures, which operations, regions, or geographies are included, whether the focus is on direct operations only or the full value chain. Time horizons are also set at this stage. Companies decide whether they are assessing short-term, medium-term, or long-term impacts and risks, or a combination of all three. Each topic on the long list is treated as a hypothesis at this point. It represents a potential impact, risk, or opportunity that will later be tested through data and stakeholder engagement. The outcome of this step should be a clear, documented purpose and scope statement. This document is critical for internal alignment and future assurance, as it explains the intent, boundaries, and expected outputs of the assessment. At this stage, sustainability matters are identified by scanning internal data, peer benchmarks, and relevant frameworks to detect actual or potential impacts, risks, and opportunities. It also requires defining whether the assessment covers the group level or subsidiaries, and which operations or geographies are included. Time horizons are set to distinguish financial exposure from societal or environmental impacts. Each topic included in the long list is treated as an IRO hypothesis. These hypotheses will later be tested through stakeholder engagement. The first task is to clearly define the objective. This may be compliance-driven, such as alignment with CSRD, EFRAG, ISSB, or GRI. It may be strategy-driven, such as prioritizing sustainability actions or updating the ESG roadmap. Or it may be risk-driven, focusing on identifying ESG-related financial or reputational risks. The second task is to outline organizational boundaries. This includes defining which entities are covered, such as parent companies, subsidiaries, or joint ventures. It also includes determining which parts of the value chain are in scope, whether upstream, own operations, or downstream. Geographic boundaries are defined based on where activities and impacts occur. Functional scope is clarified by identifying which departments are included, such as finance, HR, or supply chain. The third task is to set the time horizon. This involves deciding whether the assessment addresses short-term issues under 1 year, medium-term issues between 1 and 3 years, or long-term issues beyond 3 years. Finally, the purpose statement is documented. This documentation is important for audit and assurance purposes. Which operations, regions, or geographies are included, whether the focus is on direct operations only, or the full value chain time horizons are also set at this stage. Companies decide whether they are assessing short-term, medium-term, or long-term impacts and risks, or a combination of all three. Each topic on the long list is treated as a hypothesis at this point. It represents a potential impact, risk, or opportunity that will later be tested through data and stakeholder engagement. This document is critical for internal alignment and future assurance, as it explains the intent, boundaries, and expected outputs of the assessment. Once the purpose and scope are clear, the next step is to establish governance. Here, a governance dashboard is created. The deliverables of this step include a governance charter, a RAICI matrix, and a project plan presented in a Gantt view. Step 2 is to form the working group. And governance materiality is not owned by one function. It requires cross-functional input and clear accountability. This step focuses on assembling a multidisciplinary working group and defining how decisions will be made. Typically, companies assign a financial materiality lead, often from finance or risk, an impact materiality lead, often from sustainability or ESG. A technical subgroup is often created to support scoring, quantification, and analysis. Key roles are then defined. This usually includes a senior sponsor, such as a board member or executive, a project owner, often the head of sustainability or ESG, working group members from finance, risk, HR, operations, procurement, legal, and communications, analysts or external advisors supporting data collection and scoring governance is reinforced through a clear cadence. This may include regular operational check-ins. A final validation and sign-off session with leadership roles and responsibilities are documented using a RICI matrix, clarifying who is responsible, accountable, consulted, and informed. Responsible roles are defined as those executing tasks. Accountable roles own the results. Consulted roles provide input. Informed roles receive updates on progress. The outcome of this step is a formal governance structure, including a governance charter, RAICI matrix, and project plan with timelines and milestones. Finally, there is step 3, which is map stakeholders with governance in place. The process moves outward to stakeholder mapping. Materiality must reflect more than internal views. It needs to incorporate perspectives from those who influence or are affected by the company. This step begins by identifying all relevant internal and external stakeholders. Internal stakeholders may include board members, executives, managers, and employees. External stakeholders may include suppliers, customers, investors, an NGO, regulators, and local communities. Stakeholders are then assessed based on influence and impact. Influence reflects a stakeholder's ability to affect company decisions. Impact reflects the degree to which company activities affect that stakeholder. Based on this assessment, companies determine how each stakeholder group will be engaged. Some groups may be engaged through surveys to gather broad, quantifiable input. Others may be engaged through interviews or workshops to capture deeper qualitative insights. Sample sizes, engagement methods, and internal contact owners are defined at this stage. Stakeholders are also linked to the financial or impact lens, depending on the perspective they represent. For example, investors may primarily inform financial materiality, while an NGO may inform impact materiality. To sum it all up, influence and impact are assessed for each stakeholder group. An influence score from 1 to 5 reflects the stakeholder's ability to affect company decisions. An impact score from 1 to 5 reflects the degree to which company actions affect that stakeholder. The engagement method is then determined. Interviews provide qualitative validation, workshops enable interactive prioritization, sample sizes and contact owners are defined. A liaison or responsible department is assigned for each stakeholder group. Stakeholders are then tagged according to lens. Some are associated with the financial lens, such as investors, the CFO, or the board. Others are associated with the impact lens, such as an NGO or community groups. Building on the stakeholder mapping step, this slide shows how stakeholders are grouped and organized in practice by distinguishing between internal and external stakeholders. Internal stakeholders include employees, leadership, the board, and key departments such as finance, human resources, and operations. These groups are directly involved in decision-making and execution, and their input helps ensure that materiality outcomes are grounded in operational reality. External stakeholders include investors, regulators, non-governmental organizations, suppliers, customers, and communities. These groups provide perspectives on regulatory expectations, market pressure, societal impact, and external risk. Both internal and external stakeholders are necessary to produce a balanced materiality assessment. Internal stakeholders ensure that the strategy is realistic and can be embedded into daily operations rather than remaining theoretical. Their insights help identify implementation constraints and operational dependencies. External stakeholders ensure credibility, transparency, and alignment with broader sustainability demands beyond the organization itself. Their input helps surface risks and expectations that may not be fully visible internally. The outputs of this step remain practical and structured. At this stage, sustainability matters are identified by scanning internal data, peer benchmarks, and relevant frameworks to detect actual or potential impacts, risks, and opportunities. This includes reviewing previous assessments, industry standards, and company reports to ensure the long list is comprehensive and evidence-based. Each topic included in the long list is treated as an IRO hypothesis. This means it represents a potential impact, risk, or opportunity that will later be tested and validated through stakeholder engagement and scoring. The first action is to start in the topic's long list and enter each potential topic with a short and precise definition. Next, for each topic, IRO statements are drafted using the provided template. These statements describe how the topic could create impacts, risks, or opportunities. The sources inventory is then used to track where each topic originated. This includes internal documents, benchmarks, frameworks, and any supporting evidence. This step ensures traceability and auditability. Each topic is tagged according to value chain stage, relevant geographies, and applicable lenses. This prepares the topics for targeted stakeholder engagement in the next steps. The changelog is kept updated throughout this process. As topics are merged, split, or renamed, these changes are recorded to maintain version control and transparency. For each topic, the impact type is also defined, indicating whether the impact is actual or potential. At this stage, draft severity and likelihood placeholders are added. At this stage, a quantifiable and bias-resistant framework is developed to score materiality under both lenses, financial materiality and impact materiality. The first decision is to select the scoring method. One option is pairwise comparison, where respondents choose between two topics at a time. This approach works well when the topic list is long and helps simplify decision-making. Another option is max diff analysis, where respondents select the most and least impactful topics from a small group of options. This method is particularly useful when higher quantitative precision is required. Next, two separate survey instruments are designed. One survey focuses on financial materiality, asking questions such as which issues most affect the company's financial performance. The second survey focuses on impact materiality, asking which issues most affect people, the environment, and society. Additional enrichment questions are then included to support segmentation and interpretation. These capture stakeholder group, seniority, department, or region, and also include an open-ended question allowing respondents to flag any issues that may have been missed. The survey is then structured to generate quantitative inputs for severity and financial scoring. This includes rating questions that assess potential environmental severity or the impact of an issue on operating costs, using defined numerical scales. Before full deployment, the survey is piloted with a small group of 5 to 10 participants. This pilot phase is used to test clarity, timing, and interpretation of questions. The deliverables from this step include a finalized survey questionnaire, a pilot feedback log documenting adjustments made, and a survey that is ready for launch. At step 6, the objective is to ensure balanced representation of stakeholder voices and to define how each group's responses contribute to the final materiality scores. The first step is to set sample size targets based on the influence and impact mapping carried out earlier. For example, this may include targets such as 100 employees, 50 customers, 10 NGOs, and 5 board members. Next, weighting is defined per materiality lens. For the financial lens, higher weight is typically assigned to stakeholders with direct influence on enterprise value. This can include board members, investors, and operations teams, followed by employees and the NGO. For the impact lens, greater weight is often given to stakeholders most exposed to or affected by company activities, such as communities, employees, and customers. The rationale and assumptions behind these weightings are then documented. Each weight is justified based on factors such as stakeholder influence, expertise, decision-making authority, or degree of exposure to impacts. Fallback rules are also defined at this stage if participation from any stakeholder group falls below the target sample size. Weights are redistributed proportionally to ensure the overall integrity of the scoring remains intact. The deliverables from this step include a weighting plan, a sampling quota plan, and a rationale memo documenting the logic behind the weighting and reallocation decisions. At stage 7, stakeholder input is collected systematically through surveys, interviews, and focus groups. This is where the raw scoring data is generated, typically using 1 to 5 scoring inputs. All responses are captured and fed directly into the raw data file, ensuring a clear separation between financial materiality surveys and impact materiality surveys. The process begins by launching both surveys, financial and impact, and keeping them open for approximately 10 to 14 days. During this period, completion rates should be actively monitored, with follow-ups conducted for stakeholder groups that are underrepresented. In parallel, qualitative interviews are carried out with approximately 10 to 20 stakeholders, and these interviews are used to capture the reasoning behind scoring choices and to provide additional context that cannot be derived from quantitative data alone. All engagement activities are logged in a structured manner, including the date, participant, engagement method, stakeholder group, and duration. This ensures traceability and audit readiness. Finally, the engagement loop is closed by thanking participants and informing them when and how results will be shared. The deliverables from this step include an engagement summary report, a repository of interview notes, and a finalized raw survey dataset, typically exported as a CSV file. At this stage, survey data is converted into standardized, quantitative materiality scores for each topic and for each lens. The first step is to aggregate survey responses. For pairwise comparisons, this involves calculating how often a topic was selected as more important. For max diff analysis, a score is calculated using the wins minus losses divided by appearances, and then normalized to a 0 to 100 scale. Next, results are segmented by stakeholder group. This allows the calculation of mean scores per topic for each stakeholder category, preserving transparency on how different groups perceive materiality. Once group-level scores are calculated, weights defined in Step 6 are applied to generate overall financial materiality scores and impact materiality scores for each topic. A quality check is then performed to identify anomalies, such as situations where a stakeholder group with very low participation disproportionately influences results. The calculation of individual metrics follows a structured approach. For impact materiality, severity is calculated as the average of scale, scope, and irremediability. Impact scores are then derived either by multiplying severity by likelihood for potential impacts or by scaling severity for actual impacts. For financial materiality, scores are calculated by averaging financial exposure factors such as revenue, costs, assets, capital, and reputational impact, then converting the result to a standardized scale. Final weighting is applied by combining stakeholder weights and normalizing all results to a 0 to 100 scale. These outputs are stored in the weighted scores dataset. A materiality category is then assigned to each topic, typically classified as high, medium, or low based on predefined thresholds, such as scores above 70 being considered high. The deliverables from this step include a weighted score table, normalization, and quality control notes, and an analytical summary highlighting the top material topics for each lens. Once materiality scores have been calculated, the next step is visualization. This slide shows two common ways companies visually represent material topics. On the left, you see a bubble chart. Each bubble represents a sustainability topic. The horizontal axis shows impact materiality, while the vertical axis shows financial materiality. Topics positioned higher and further to the right are more material under both lenses. The size of the bubble often represents a third variable, such as stakeholder importance or risk magnitude. This allows decision makers to immediately see which topics require priority action. On the right, you see a scatter plot with organic zones. Here, topics are still plotted across impact and financial dimensions, but the background zones visually group topics into areas such as emerging, significant, or critical. This format helps communicate not just ranking, but relative urgency, especially for executive audiences. Topics falling into the upper right zone typically demand immediate strategic attention and disclosure. You might notice some additional visualization approaches that add a time and classification perspective. On the left, the scatter plot with future trends shows how topics may shift over time. Arrows indicate the direction and magnitude of change, reflecting how certain issues become more financially or impact material in the medium to long term. This visualization is particularly useful for strategy discussions as it highlights emerging risks and opportunities that may not yet appear critical, but are expected to grow in importance. On the right, you see a quadrant-based matrix chart. This format explicitly categorizes topics into defined materiality zones, such as impact material, financially material, or double material. Each topic is placed based on threshold levels rather than relative positioning alone. This approach is especially useful for regulatory reporting as it clearly supports disclosure decisions by showing which topics meet formal materiality criteria. At this stage, it is important to pause and acknowledge that what we have covered in this course is the practical and strategic understanding of materiality. For companies operating under CSRD, there is an official and very detailed implementation document that goes much deeper into the technical, procedural, and documentation requirements of the materiality assessment. This document is the FRAG implementation guidance on materiality assessment. It provides an extensive explanation of expectations, methodological choices, documentation standards, and audit readiness under ESRS. If you are responsible for executing, validating, or signing off on a materiality assessment, this guidance should be treated as a core reference document alongside your internal methodology. As materiality assessments become more data-intensive and more tightly scrutinized, many companies choose to support the process with specialized software tools. And these tools are designed to handle large volumes of sustainability data, connect internal company information with external research, and structure impacts, risks, and opportunities in line with double materiality logic. They are especially useful when time is limited, internal data maturity is low, or when consistency and auditability are critical. One tool that is particularly well regarded in this space is Upright. Upright's approach is based on connecting company and product data with global research databases, supply chain information, and public data sets. This data is then processed through a double materiality framework to assess a wide range of sustainability impacts, risks, and opportunities. It is important to note that software tools do not replace judgment, stakeholder engagement, or governance decisions. Instead, they act as a decision support layer, helping teams focus their time on validation, prioritization, and strategic discussion rather than manual data collection. Used correctly, these tools can significantly improve efficiency, consistency, and credibility within the materiality assessment process. To support this, a double materiality assessment template has been provided. This Excel-based tool is designed to operationalize everything we have covered so far, from topic identification and IRO definition to scoring, weighting, and final materiality outputs.